Welcome back to the Deep Dive. Today we are looking at a really interesting one. It's Weyerhaeuser, ticker WY. This company is kind of the ultimate blend of old school assets and, well, current market pain.
Absolutely. We're talking about a timber giant, one of the biggest private landowners really in the world. Their value is literally, rooted in the ground.
It really is. And what makes this fascinating right now and why we're doing this deep dive is this huge disconnect we're seeing in the valuation.
Yeah, that's the core puzzle.
So get this. The stock's hovering near its 52-week low, around $24.44 when we looked, October 9th, 2025.
Pretty beaten down.
But then you look at Wall Street analysts, they're seeing, 34%?
Yeah.
Even up to 40% potential upside. Their average price targets are way up in the mid-30s.
That kind of gap, it just screams either deep value opportunity or, potential value trap.
Exactly.
The market price today clearly reflects the immediate fear, mostly around the housing slowdown. But those analyst targets, they're looking at the durable value, the irreplaceable assets underneath.
So our mission today is to cut through that noise. We're going to unpack the sources we've gathered on Weyerhaeuser, its structure, how it's managed, even some geopolitical factors giving it a bit of a buffer.
And figure out if this is a smart cyclical buy or just something that's going to drag down your portfolio.
Right. Let's start with the basics. Part 1, the fundamentals, business, management, and financials. Chapter 1, the business of trees, understanding Weyerhaeuser's roots.
Okay, so first off, Weyerhaeuser isn't just like a simple lumber company. It's structured as a real estate investment trust, a REIT.
And that REIT status is really key, isn't it? Especially for anyone looking at dividends.
Absolutely critical, because legally, as a REIT, it has to pass the bulk of its taxable income straight through to shareholders.
Which is why it's been such a foundational dividend stock for so long.
Exactly. And the business itself, it breaks down into three main parts. First, and arguably the most important, is timberlands.
Right, the trees themselves.
This is their core asset, their moat. They own outright 10.4 million acres of really productive timberland in the U.S. Plus, they manage another 14.1 million licensed acres up in Canada.
Wow, that's huge.
It's vast. This segment basically grows the trees and harvests the raw logs.
Okay, segment 1, timberlands. What's next?
Segment 2 is wood products. This is the manufacturing side. They take those logs
And turn them into stuff people build houses with.
Precisely. Structural lumber, OSB, that's oriented strand board, and also engineered wood products, EWP, like their Timber Strander brand. This part is very tied to residential construction, highly cyclical.
Makes sense. And the third piece?
The third is REN, stands for real estate, energy, and natural resources. This is where they try to squeeze more value out of the land beyond just the trees.
Okay, like what?
Selling off parcels that aren't core to their timber strategy, maybe leasing land for solar farms or wind projects, and importantly, developing their new natural climate solutions business, NCS.
NCS. That's the carbon credits thing, right?
Yeah.
The sources mention this. Why is that such a big deal if it's still pretty small?
Well, it's about the potential margin. Yes, it's small now, but think about it. It uses the same core asset, the land, the trees, but generates revenue that's completely separate from the housing cycle.
Okay. Diversification.
And potentially much higher margins than just selling 2x4s. The sources suggest that once NCS scales up, it could be a significant high-margin contributor.
Interesting. Okay, so beyond the assets and structure, there's this weird geopolitical thing helping them right now.
Yeah, it's a major factor, a non-market tailwind, really. The U.S. imposed tariffs on Canadian lumber back in 2025.
I remember hearing about that. What were the numbers again?
It was 10% on Canadian softwood and a pretty hefty 25% on derivative products.
And since Weyerhaeuser is mostly U.S.-based?
Exactly. It directly bumps up the costs for their major competitors from Canada. So even in this weak housing market, these tariffs potentially give Weyerhaeuser a bit more pricing power, a little cushion on their margins.
It's sort of protective barrier, even with high interest rates hitting housing.
Correct. It's a significant advantage, at least for now.
Chapter 2, Management Evaluation. Speaking of those high interest rates in the downturn, let's talk about management. The CEO, Devin Stockfish. His background isn't traditional forestry, is it? More like M&A, finance, law.
Right. And you can kind of see that reflected in their priorities. The sources really emphasize capital allocation, maybe even more than just operational forestry tweaks.
So how are they handling this slowdown?
Well, the sources point to a pretty clear proactive response. They're focused on cost control naturally. but also making strategic production cuts. They planned to reduce lumber output in Q3 2025, for example, to try and manage supply and support prices.
And what about that M&A strategy? It seems pretty sharp.
Extremely disciplined based on the examples. They're actively optimizing the land portfolio, selling off assets that maybe aren't as productive or are in less strategic areas, often at really high multiples.
Like that South Carolina deal.
Exactly. Sold land there at something like 47 times EBITDA. Then they turned around and bought more productive timberland in North Carolina at only 21 times EBITDA.
Wow, that's textbook sell high, buy low.
It really is. It shows a clear focus on creating value through smart capital moves, not just hoping the cycle turns.
And they're putting capital back to shareholders too, right? With the stock price being low.
Aggressively. They ramped up share repurchases, did $100 million in buybacks in Q2 2025. That was the highest quarterly amount since 2022. And then immediately got authorization for a new $1 billion buyback program.
$1 billion. That's a serious commitment, especially now.
It's a huge vote of confidence for management in the underlying value, and it ties into their dividend policy, too.
Ah, the base plus variable supplemental thing.
Right. They aim to return about 75–80% of their adjusted FAD funds available for distribution to shareholders. But they do it smartly. There's a reliable base dividend protected by that long track record.
55 years uninterrupted, the sources said.
Incredible streak. And then in the boom times, they pay out extra via variable supplemental dividends. In downturns, they can cut the supplemental part without touching the base, protecting that streak.
But wait, spending potentially $1 billion on buybacks now? Isn't management basically betting the farm that interest rates will come down soon and housing will recover? What if this slump lasts another, say, 3 years? Does that buyback look less smart then?
That's absolutely the risk they're taking. It's the core bet. But their thinking, judging by the sources, is anchored to the asset value, when the stock is trading this far below what they believe the land alone is worth.
Buying back shares looks like the best investment they can make.
Exactly. Better than, say, pouring money into new mills when demand is low. They see it as buying their own irreplaceable assets on sale.
Chapter 3, Financial Analysis.
Okay, looking at the numbers, the cyclicality is just, well, unavoidable. Stark, really.
Yeah, the peak years, 2021, 2022, revenue was over $10 billion.
Correct.
Yeah.
But fast forward to mid-2025, TTM revenue trailing 12 months had dropped to around $7.04 billion. Big drop.
And net income followed.
Even more dramatically, from a peak of $2.6 billion in 2021 down to just $396 million reported for 2024.
Ouch. That volatility is clear. But the underlying financial health.
Seems quite solid, actually. Their debt-to-equity ratio is manageable, around 0.54. That suggests a pretty strong balance sheet. And, again, you can't ignore those 55 straight years of dividends. That speaks to real financial durability, not just profits when times are good.
Okay, so financially stable, but earnings are way down, which leads us to this valuation trap idea.
Precisely. If you just run a basic stock screener right now, Weyerhaeuser looks incredibly expensive. The trailing PE is over 60. The forward PE is like over 100.
Which seems crazy high.
It does. But that's the classic trap with cyclical stocks. PE ratios are often backward-looking or based on near-term depressed earnings.
So the EMPE is artificially low right now, making the whole ratio look inflated.
Exactly. It's often a contrarian indicator at the bottom of a cycle. High PE can actually signal a potential trough.
So if PE is misleading, what do analysts use?
They tend to lean on methods that look further out, like discounted cash flow or DCF. These models try to account for the inevitable recovery in earnings and cash flow.
And what do those models suggest?
Well, educational DCF estimates based on consensus analyst forecasts for a return to more normal margins over time point towards an intrinsic value around $32.58 per share.
Okay, hold on. $32.58 intrinsic value versus a $24 stock price. That's a big claim. What's the key assumption baked into that DCF? Is it all riding on a quick housing recovery? What happens if rates stay high for years?
That's a fair question. While the timing of realizing that value depends on the recovery, the $32 figure itself is heavily underpinned by the sheer value of the physical assets, the 10.4 million acres.
So the land acts as a floor.
In a sense, yes. Even if the housing market stays weak, the trees keep growing. The land itself is a store of value, arguably an inflation hedge. So a delayed recovery might push out the timing in the DCF model, but the fundamental asset-backed value proposition remains largely intact. It provides a strong anchor for that valuation.
Part 2. Market, risk, and conclusion. All right, let's try to bridge this gap. If the fundamental analysis, the DCF, Points north of $32. Why is the market hammering the stock down to $24? We need to look at sentiment and who actually owns this thing. Chapter 4, Market Sentiment.
Okay, starting with the pros, the Wall Street analysts. Overwhelmingly bullish. The consensus rating is consistently buy or strong buy.
And those price targets reinforce that.
Definitely. The average one-year target falls consistently in that $32.82 to $34.07 range. They clearly see the fundamental value we just discussed.
So the analysts are yelling buy, but the stock chart looks pretty grim.
That's the disconnect in a nutshell. The technical picture is bearish. That $24.44 price, it's trading below both its 50-day moving average, which was around $25.30, and its 200-day average, near $27.
Signaling negative momentum, short and long term.
Right. Price action is currently winning the argument against fundamental value in the market's eyes.
But if things were truly dire, wouldn't we see lots of short sellers piling in?
You'd think so. But the short interest is actually quite low. Only about 2.48% of the float is shorted. That suggests the sophisticated money, while maybe cautious about the timing of a recovery, isn't making a massive concentrated bet that the company is, going bust or fundamentally broken.
Chapter 5, Ownership Structure. Okay, so who does own Weyerhaeuser?
It's overwhelmingly held by big institutions. Think Vanguard, BlackRock, State Street, the giant asset managers. They own something like 90% of the outstanding shares.
Wow, 90%. So this is a core holding for a lot of large, probably long-term oriented funds.
Exactly. It suggests the stock has been thoroughly vetted by professional teams who value that asset stability and the dividend history.
That institutional backing adds some weight. What about insiders? The people running the show?
Well, direct insider ownership is pretty low, only about 0.306%. That's not unusual for a company this large and this old.
Okay, but is there any trend? Are they buying or selling?
The trend is positive, which is encouraging. Over the last 12 months, insiders have actually been net buyers of the stock.
Oh, interesting. Any significant buys?
Yeah, the sources highlight one notable purchase. A director bought 4,000 shares back in August 2025, right as the price was slipping under $25.
Buying on weakness, that's usually seen as a pretty strong signal of confidence, isn't it?
It's generally considered one of the most authentic signals, yes. Putting your own money in when the market is fearful.
Chapter 6, Risk Assessment.
So let's boil down the risks and strengths. On the strength side, it's clearly that irreplaceable asset base, the sheer scale, the cost advantages that come with it.
And the weakness.
Extreme cyclicality. It's just so tightly linked to commodity prices, especially lumber, and the overall health of the U.S. housing market. That's the big vulnerability.
Okay, what about opportunities? What could help close that gap between the stock price and that intrinsic value estimate?
Well, in the immediate term, those U.S. tariffs on Canadian lumber are a key factor. They provide that buffer, that potential for better pricing power.
Right, the geopolitical edge.
Looking longer term, there are two big potential drivers. First, the continued growth of that Natural Climate Solutions NCS business. Selling carbon credits offers a path to non-cyclical, potentially high-margin revenue.
And the second?
The fundamental structural shortage of housing in the U.S. Everyone knows we haven't built enough houses for years. Eventually, that pent-up demand has to be met, assuming affordability improves. That's a major long-term tailwind for wood products.
Okay, those are the opportunities. What are the clear threats? What keeps a Weyerhaeuser shareholder up at night?
Threat number one, highlighted everywhere, is the macro picture. High interest rates. That's the main thing choking off housing demand right now.
The biggest headwind.
Absolutely. Then there's political risk. Those are the helpful tariffs. A different administration could potentially roll them back.
Good point.
And finally, since their core asset is physical and outdoors, there's always environmental risk. Wildfires, pests, tree diseases. These are real threats to the timberlands themselves.
Chapter 7. Conclude.
Okay, so wrapping this all up, the bull case for Weyerhaeuser really centers on the quality and irreplaceability of the assets that land moat. Add to that disciplined management, making smart M&A moves, and returning cash via buybacks.
Plus the tariff tailwind and the potential growth from the NCS carbon credit business.
Exactly. That's the bull argument. Quality assets, smart management, some helpful external factors, and a new growth angle.
And the bear case.
The bear case is much simpler, much more immediate. It's almost entirely about the overwhelming cyclical headwind from high interest rates crushing the housing market.
The risk isn't that the company collapses, but that the recovery just takes much longer than expected.
Precisely. The risk is one of time and opportunity cost. You might be holding an undervalued asset, but if it takes 5 years for that value to be recognized because rates stay high, your capital is locked up.
So the core finding seems pretty consistent across the sources. The stock, trading around $24.44, looks significantly undervalued compared to that educational intrinsic value estimate we talked about, around $32.58.
Yeah, it seems like you're potentially buying a dollar's worth of assets for, maybe 75 cents. The catch is you don't know exactly when you'll get the full dollar back.
Right. So the bear case, the fear, it's fully reflected in today's stock price and the negative momentum. The bull case relies on long-term tangible value, plus factors like tariffs and carbon credits that haven't fully hit the bottom line yet. Which brings us to the final thought for you, the listener. The central question here seems to be one of patience. Are you willing to own a fundamentally strong company with irreplaceable assets while you wait potentially for a while for the housing cycle to inevitably turn and for those other opportunities like tariffs and NCS to fully mature?
That really is the crux of the investment thesis right now.
A lot to think about there. Before we sign off, just a quick reminder, if you find these deep dives valuable, please like and subscribe to Stock Analytics AI. For €4.99 a month, members get priority access to deep dives on tickers you request. We're planning to cover all S&P 500 stocks over the coming months, and members get first dibs.
And if you just want a one-off deep dive on a specific company, you can always drop us a super thanks.
And finally, the necessary disclaimer.
Remember, everyone.
This analysis was generated by an AI system for educational purposes only. It should definitely not be considered financial advice. Always do your own research, or, better yet, consult with a qualified financial advisor before making any investment decisions.